This video is going to take a look at an important ratio for investors, the dividend cover ratio. And this video goes alongside another video on dividend yields. We're not going to spend too much time on dividend yields here for that reason. This is going to focus on an important backup ratio for anyone looking for income generating stocks, the dividend cover ratio. Now, dividends are crucial. A couple of studies have revealed that since 1925, dividends have accounted for 44% of the total return from US stocks, that's S&P stocks. So dividends are crucial. That's half your return, basically, coming from dividends rather than capital gains or growth. So a lot of investors, quite rightly, in the current climate, are looking around for decent yielding stocks that will generate a steady income and allow them to accumulate by reinvesting a decent lump sum investment. And just bear that in mind before we jump in with dividend cover. Essentially, when a company makes profits, let's say 100 million sterling, bear in mind the directors basically have two choices when it comes to rewarding shareholders. You either pay out a dividend, and in a moment we'll take a look at something called the payout ratio, which is just a twist on the dividend cover story, or you keep those profits and grow. So as an investor, some investors look for decent income stocks. They're looking for what we'll call a decent payout ratio, a decent yield, and they're less concerned about fast growth. So maybe they're looking at something like a utility company, for example. Other investors, frankly, are happy to sacrifice income short term, at least, to get decent growth. So today's video focuses very much on this side rather than that side. Over here, ratios like PE ratios are quite important as a way of measuring the price of a share in sort of earnings growth terms and so on. But we're going to focus over here for today. So, what is dividend cover? Where does it fit into the picture? Well, imagine I'm looking for stocks and I'm trying to set up an income-based portfolio, and I've discovered that a stock pays a 2p dividend per share, and the current share price, let's say, is 10p per share. As a percentage, 2p over 10p times 100% is a rather generous looking 20% yield. Now you might say, fantastic, where else can I get that kind of yield? Not on a bank account, there's no ISA paying that amount. Corporate bonds, I'm struggling to find 20%. So you might think, oh, I'm going to snap that up. But here's the point. Dividend cover asks the question, is that actually sustainable? Can the directors continue to maintain that sort of yield? Because if they can't, you're not really buying an income stock. You're possibly being bribed into buying a stock short term that actually might be about to cut its dividend in the near term. So dividend cover is one of the safety checks you can perform to just check, well, actually, how sustainable is that yield? Is my hunch that maybe that yield isn't sustainable backed up by anything tangible? So how does it work? Well, dividend cover would say, fine, okay, Tim, the dividend is 2p per share. That came out of earnings. So what we could do is we could take a look at earnings per share. So let's say that the company made profits after tax but before dividends of 100 million, and the number of shares in issue, that's normally the ordinary voting shares, is, let's say, 500 million. If that's the case, profits after tax 100 million, that's profits for the year before dividends are taken out. So that's the profits available potentially to pay dividends. Shares in issue 500 million. So earnings per share, roughly speaking, 20p. All right. Now, if earnings per share are 20p, you can then say, well, actually, if EPS is 20p, in theory, the directors could have paid out a dividend of all of that, 20 pence per share. They didn't in my last example. They chose to pay out a dividend per share of just 2p. So, the number of times earnings per share covered the dividend per share is 10. And dividend cover of 10 times would be pretty impressive. So that's saying that they could have paid out that dividend 10 times over before they ran out of profits in the current year, let alone some of the profits available in previous years. Because in theory, most of the accumulated profits, they're known as profit and loss reserves or retained profits, could also have been paid out this year as a dividend, but the directors don't need to worry about that because they're covering, even out of this year's earnings, the dividend 10 times. So that looks, on the face of it, good. And in theory, indeed, the higher dividend cover is, the better. What's good? Well, difficult to be prescriptive. If I was looking around the UK market, I would feel reasonably confident in the current climate if a company could cover its dividends, let's say, twice or more. But even at that level of cover, if you were to run a stock screen, that will reduce it down quite considerably. And that's a rough guide. 2 or more is a rough rule of thumb there. Okay, so how else can we use this information? Well, there is something called the payout ratio. For example, a recent banking report identified the fact that payout ratios are very low, near a 40-year low. What does that actually mean? Well, the payout ratio is simply a reworking of dividend cover. Because what the payout ratio says is this. If you flip this ratio on its head, you can say, well, if dividends per share are only 2 pence, but actually earnings per share available to pay the dividend are 20p, then the payout ratio, i.e. the amount paid out as a dividend as a proportion of what could have been paid out, is just 10% for this particular company. And that's very low. At the moment in the UK, for the sort of bigger blue chip stocks, FTSE 100 and so on, the ratio's closer to more like sort of 30-35%. But nonetheless, payout ratio of 10% would be considered low. And so some investors would say, well, combine a low payout ratio with a decent yield and a few other checks, which we'll cover off in just a moment, and you've got potentially quite an interesting looking stock. So, dividend cover, high is good in the sense that the more times the company covers its dividend, the better. Makes the dividend more likely to be repeated in future years, it's a bit safer. And the payout ratio is simply almost dividend cover flipped on its head to say, well, actually, what's the scope, therefore, for increasing the dividend? Because subject to a couple of checks we'll look at just in a moment, a company with a low payout ratio may be in a position to increase it in future years. So what are those other checks for dividends? Now, some of these are covered off in more detail in other videos. So a quick checklist on other ways to test a company's dividend. What else would I be looking for? So, other tests. First of all, what's the dividend policy? The directors have to update the market on where they think dividends are going, at least once a year, typically 6 months, maybe even quarterly. So take a look at what the directors are saying about dividends. What's their policy? Are they aiming to increase dividends by the RPI plus a bit? And have they managed to achieve their targets in the past? So 5 years ago, if they said our aim is to increase dividends by RPI plus an amount, that's inflation plus an amount, did that pan out? Do you believe them? Do you trust them to deliver? Because you want consistency. and I'd look for consistent growth over, let's say, at least 5 years. So take a look back, see how dividend policy has panned out over the last 5 years. Is there a nice upward steady trend in dividends? Not 1 year big dividend, next year a cut, then restored, then altered. You want a nice consistent trend. As an income investor, remember you're looking over the long term. You're not looking for just a one-off windfall this year that then can't be repeated next year. Cash flow. Again, we cover this elsewhere in more detail, but essentially cash flow per share. Is the company generating decent cash flow? A quick look at the cash flow statement will give you at least some insight into the amount of cash available to pay dividends, sometimes known as free cash flow. That's the cash flow generated by the firm's operations once you've knocked off one or two non-discretionary items. So cash flow, very important. Decent cash flow tends to suggest decent dividends. And a common sense check works here without doing too much numbers. Step back, what type of business is this? Utility companies enjoy nice, steady cash flow. We all pay our bills generally on time to a schedule. So utility companies often can maintain generous dividends. So too can, say, food retailers like a Tesco, because they've got cash washing in, day out consistently. And it's those sort of consistent cash flow businesses, you don't need to be an accountant to identify them necessarily, but will tend to be the more reliable dividend payers. A low payout ratio, we mentioned that already. You know, if a company's already paying out 90% of its profits as a dividend, with the best will in the world, then the directors can't just keep boosting that. They're probably operating at their limit in dividend terms, but you know, a payout ratio of 10% suggests there's a lot more room for manoeuvre. Or, conversely, high dividend cover suggests the same thing. And finally, again, something we cover elsewhere, so I won't labour it today, a strong balance sheet. Quick look at the balance sheet. So how much cash is sitting on the balance sheet, and maybe take a look at the last couple of years as well. And you know, evidence that the company doesn't carry a lot of debt, for example, and therefore hasn't committed lots of its profits and cash flow to paying interest, is another sign that the directors ought to be in a position to maintain dividends and increase them according to their stated policy.